Hi, everybody. I am Michelle Morris from Consolidated Planning Group. That's what CPG stands for in my name there, Consolidated Planning Group. We are going to have a great webinar today with Shelli Dodson. She is a CPA and she understands all of the nuanced rules and regulations that surround special needs benefits and resources and how to, what you need to take into consideration when you're filing taxes and you're getting all of these benefits. Michelle says she's hearing a lot of echoing. Let me know if that's everybody or just her in the chat, please. All right, so Consolidated Planning Group, first and foremost, we are financial advisors, but we serve mainly families in the special needs community. So we can help you whether you have a child with needs or not. But we really focus on educating and advocating for the special needs community. And we're so glad that you're here today because education makes people and communities stronger. So thank you for being here to get some good information. You're taking a great step to help not only your family, but your friends and neighbors as well. The more people we have with correct answers to some of these questions, the better off we're all going to be. So we cannot hear you or see you because we're in webinar mode. So please use the chat box for any questions or comments. We do welcome those. We want you to ask questions. And we'll get to as many of them as we possibly can, but use the chat box. The other thing I want to let everybody know is that we do record all of these webinars as we're presenting, and then we put them on our YouTube channel and our podcast. So if you prefer to listen on our podcast, or maybe right now is not a good time for you, you need to come back later and finish up the webinar or something like that, you can always check our YouTube channel. Or if there's a topic that you're curious about, you can go there for information. Now, if you have registered for today's webinar, you're going to receive an email later that will have a link to that recording and also the slides that we go through today. So everybody should get that in their email. If you happen to be already on our YouTube, or maybe you're listening on our podcast and you want us to send you the slides, we can do that. Just email contact@cpgcares.net. Contact@cpgcares.net. We'll be able to get you those slides. So again, we are a holistic, special needs focused financial planning firm. We're located just outside of Houston, but we do serve families all across the United States. So for our friend who introduced himself in California, no problem. We can help you and anybody in your community that you know all across the United States. We've been doing this for over 30 years. We are not only members of the Special Needs Planning Academy, we are chartered special needs consultants, and we're national Social Security advisors. But I think our biggest source of experience and expertise comes from the fact that all four financial advisors at Consolidated Planning Group are parents to loved ones with needs. So we live this, we breathe this, not just in our work lives, but in our personal lives. And it's truly in our hearts to help you make sure that the financial vehicles are in place to make sure that your loved one will be taken care of even after you are gone. So we do life insurance, investments, special needs plans, benefit and resource planning, Social Security, all of those different aspects of your financial future. Families come to us for those lifetime care plans, protection plans, thinking about how the ABLE account works and the special needs trust and the waiver programs and how they all kind of work as a puzzle to help you take care of your loved ones. We help families think through that future cost of care, how much money really needs to be in that special needs trust, how to get all those state and federal benefits and local resources. And again, we're here to advocate for you and to educate you. And it's pretty rare you're in the right place because fewer than 0.1% of all the financial advisors in the United States focus on special needs planning the way that we do. Um, there's over 263,000 financial advisors in the US and fewer than 200 who can really help you understand the nuances and rules and regulations and tricks to planning for your loved one. So, a couple of things we always want to put out there advice for everybody is to start planning as early as you possibly can. Giving yourself a longer runway is going to make small incremental changes more impactful and make things easier on your family long term. If you wait, if you kick the can down the road or, ignore the problem, it's not going to go away. With careful early planning, things are going to be so much better for you and more relaxed and easier. So think about what's going to happen after high school. There are educational options, vocational options, residential options, but some of these might have wait lists. And of course, you might want to tour these opportunities before you send your child there. So get out there, see what's available to you and your area and your budget and what is going to be good for your family and plan early. The other thing is name caregivers thoughtfully. Once you're gone, who is going to take care of your loved one? Some people just assume a sibling is going to be a great caregiver, but that's not always the case. It can create resentment on both sides of that interaction because here, maybe older sister Sarah has always told you, oh, yes, we would love to help out with little brother Jacob in the future. When you're gone, we'll help. We love him. Of course, we'll help. But then Sarah's older. She's got a job. She's got her own family, her own children, and she might realize that it's a much bigger ask than she thought when she was a child. And now she feels this sense of obligation that can cause resentment. And on the other side, think about little brother Jacob. Here he's had his sister Sarah. They've been partners in crime. They've been best friends. They've been running mates. But all of a sudden, Sarah wants to try to act like a caregiver, like mom. And that might feel a little stressful for Jacob. Why is my best friend trying to control me? So just be very careful with that dynamic if you think it's going to work for you. Okay. So without further ado, we are going to turn things over to you, Shelli. Thank you so much for being here to give us some information on CPA, on taxes. And please, everybody, like I said, put your questions and comments in the chat.
Thank you, Michelle. Hello, everybody. I am Shelli Dodson. I am a CPA, and I am also a mom of a special needs kiddo. My Max is 13 years old, and he was born with, we think he was born normal, but he had a stroke. And so now we have developmental delay and all kinds of little fun things that go along with that. So helping families with special needs has become close to my heart because we are a family with a special needs child. I do have two older siblings. They are out of high school and Max will be in high school next year. So I don't know everything about special needs territories because you guys, there's so much that we have to know as parents and so much that we won't know because our child isn't in a specific place. Everybody's child is a little bit different. But what I love about doing this and what I love about doing taxes with special needs families is that I can take the information that I learn here and pass it on to the families that I interact with, be it Max's friends, just people in the community. So I'm happy to help. I don't know everything, but I know there is an answer for everything. And so I can help there when I can. So we're going to look today at taxes. Some of this will have an overlap with some legal stuff. I am not an attorney by any means. I work great with your attorneys. I work great with your financial team. And when you have those three pieces of the pie together, it makes for a holistic look at your whole situation. So I implore you, if you're going to team up with somebody, team up with people that work together. I know that I work with CPG. We communicate with each other. They've done a plan for me, so I know how they work, and I love the methods that they utilize and what they were able to teach me and what they taught me. I was able to share with some other clients of mine. So let's
You for
jump
that.
into all these fun questions that come with special needs and our kids, and how are we going to take care of them? So the first thing is the trust. Typically, there are two types of trust, a first party trust and a third party trust. And it can be very confusing, but we definitely have to start with these steps. The first party trust is a trust that is formed with the beneficiary's own dollars. So if your child was, or sibling or brother, sister, if the beneficiary was involved in some kind of maybe accident and they received a settlement for that accident, that is their money. That goes into a first party trust. If they receive child support, that is their money. That can go into a first party trust. The first party trust does have some negatives, as that it can be clawed back when they pass away. Medicaid can actually come in and claw back some of those dollars. That compared to a third party trust, which is probably what most of us are looking to for our children, is when I die, what happens to my money and how can I get that into a trust for my child? Or when my mom passes and she wants to leave money to my child, how can she leave money to him without potentially impacting his overall benefit? How do we get that to them without hurting them? And so the third party trust allows us to do that. That is going to be someone else's money that's put into trust for the child. So there's no payback on that when it comes to Medicaid because that money never belonged to the child. You can establish that, excuse me, you can establish that for any disabled individual. I have a third-party special needs trust that we have done the paperwork for, but it will not be funded until my passing. So it is it's kind of sitting here over the side. My beneficiaries on life insurances and things like that are the special needs trust. So when something happens to me, that trust will become alive and we'll start having a filing requirement and start generating income. But until the time that that happens, any funds that I might give to that trust, those will be in my possession and my custody. It's flexible. Both of these kind of trusts allow for us to make payments from the trust to support the children without potentially impacting their overall benefit. So let's see the next slide.
A couple things. I just want to
Yep.
highlight the importance of two different things I heard. First of all, child support. If child support is a thing in your life, and it's even more common in families with special needs kids that there is divorce than it is in the general population. If you have child support continuing beyond age 18, that needs to go into a first party special needs trust. And if not, it will impact your child's SSI benefits. So please watch out for that. And the other thing that you mentioned is, oh, keeping your money in your own name until you pass away and then it goes to the trust leaves it more flexible for you. That's the most flexible way to have your money, right? And if you need it for your own things, you have the availability to be able to use it. Whereas if it's in that trust already, it's not as flexible. So just be careful with that. So some people have the testamentary trust like you have where it's in your will, and other people have a standalone trust, and that would be good for like when mom or dad or an aunt or uncle or friend wants to leave money to the child.
And I want to point out, Michelle, thank you so much for that. And I think that proves to the audience that our interaction with each other is very important. You can't lean on just one professional because one professional cannot know it all and they can't remember everything. And so Michelle's coming to you with her aspects of all the families that she helps, and then I bring in. So I think that's a perfect example of how well we work together. So,
Yes, yes, thank
um,
you.
we do have a question about the grantor having to pass before we fund the trust. And I would say just purely from a tax standpoint, like Michelle said, we want to keep the money in our own possession and have it at our taxable level. Because when you get a few slides down, you're going to see that there is not a favorable tax position for a trust. And we'll explain that in a few slides. Well, we're going to start here. So the first party special needs trust is what they call a grantor trust. And so it is typically can be disregarded for tax purposes, meaning that the income that that trust generates will be taxed on that person's individual 1040. We like that taxation because it is favorable to the trust brackets. A third party special needs trust, this would be an example of one that I have. I've got it sitting over there, but I haven't funded it. So the money is in my possession. I'm paying I'm paying tax on the income that it generates. And that is favorable to me. Once I pass, my trust will turn into a non-grantor type of trust where it is required then to file a tax return 1041. So the trust is a separately recognized entity from an individual in this position. The income that it reports is going to come from dividends, interest, capital gains, whatever asset that trust is holding is going to potentially generate income that would be taxable to the trust unless we do some things later. We are considering purchasing a home to put into the trust. We're not sure yet if we're going to do that, but it is a consideration for us. We want to make sure that maybe Max has a place to live, or maybe it's going to generate rental income for the trust that then can support his overall needs in the future. So a lot of things can go into the trust, but the trust definitely needs to be set up with an attorney, with the appropriate language needs to be added. And that's something that I cannot advise on being a non-attorney. Typically, when you do have a trust return that owes a tax return, generally speaking, the 12/31 is your cutoff date. And so April 15th is the due date of that tax return. You can extend it. I probably have 10 on extension right now. So let's see.
Yeah, it's pretty common, huh?
Yeah. We like extensions in my world. They're not bad.
Yes. So yeah, anybody can put money into a person's special needs trust, but they can only have one of each type. Is that how that works?
Right, you only have one of each type. So if my mom decides to leave money to Max, we would never have her leave that to him directly. We would have her leave that to his special needs trust that we've established. And at that point, it would become necessary to file tax returns for that trust. So so I think the key point of this, if it's the child's money, it's the first party special needs trust, which remember has the clawback provision with Medicaid. If it's someone else's money, then that's going to go into that third party trust, and someone else's money is going to be inheritance. Typically inheritance, I have life insurance that's going to fund my third party special needs trust if it's not funded prior to that. You can have your Roth account go into that. You can have your IRA account go into that. I did have a call the other day, and I think this is probably a great point or a place to make this discussion. Had a call from a gentleman. He has an IRA and he has a Roth IRA. And his question was, what do I leave to the trust? My suggestion to him was during your lifetime, try to get that pre-tax money into an after-tax account and then leave the Roth to the trust. There are rules on how long the money can stay in the Roth after the trust receives it. But in one of our clients right now, she has a Roth and we're leaving that money in there until the last possible second because that money inside of that inherited Roth IRA will continue to grow tax-free. Once it comes into the trust, we will lose the tax-free benefit that it grows. So that was an important conversation for him and I to have so that he could start navigating, moving some money out of a pre-tax environment to a after-tax environment.
Right, right. So, I mean, it's really important, as you were saying earlier, how people need kind of a support team around them because you need an attorney to set up the special needs trust. Whether it is a testamentary trust in your will and it won't start being funded until you pass away, or a standalone trust, whether it's a first party or a third party, whether it's grantor or non-grantor, which Shelley will explain after I make this point, you need an attorney to set it up. You need financial advisor, us at Consolidated Planning Group, to tell you how much needs to be left in the trust so that your child will be taken care of after you're gone. And where is that money going to come from? How can we help manage your assets so that when you're ready to leave your 401k or whatever to the special needs trust, there's going to be enough for your child. And then you need a tax person like Shelley to help you figure out the nuances of which money to use first and how to make it the most advantageous for your family. Shelley, can you tell us the difference between grantor and non-grantor trusts, please?
Yeah, so a grantor trust is where basically the trust for taxation purposes is invisible. And the income that that trust earns is taxed to an individual. Maybe in a first party situation, that individual is the beneficiary. In my situation, that grantor is me, and so I pay tax on that. A non-grantor trust is where that money is coming from someone else going into the trust. And so it is taxed at the trust level unless we do things to get the income out of the trust. And that's that's as simple as I can make it. We got the attorneys involved and it gets a little bit long-winded, you know?
Yes,
I love
yes.
my attorneys. There is a question about a 401k into a trust. Yes, you can put a 401k into a trust, but we need to be so a 401k by nature is pre-tax money. So whoever receives that money is going to end up paying tax on it. And so depending on how much money is in that 401k, you can really send a lot of that to the IRS. So that's why we were talking about the client that we worked with earlier. If we can get that kind of money into a after-tax situation during our lifetimes, it's usually more favorable. Let's see. And then one type of trust. So you can't have 3 or 4 first party special needs trust. You can only have one. And same thing with the third party. So if you create like in me, we've created a third party special needs trust, and we'll give that information to my parents if they want to leave money to Max or to his dad's parents. Everybody will fund that one trust. Let's see.
And you do that through a tax ID number, so
Right.
money doesn't get confused. It's all good.
Right. Okay, so the fun part. This is where it gets a little bit interesting to be a trustee of a trust, because we are dealing with different types of income. We have taxable income, which is going to be what the IRS is looking at. And then we're going to have income for SSI purposes, which is your means-based program. And those dollars can count in different areas. And so for us, taxable income is going to be wages, self-employment income, interest, dividend, rentals, things like that. They're not exempt from federal income tax. Pretty much they mirror what you would file on your individual 1040. There are some things that our special needs kiddos can earn that is not considered taxable income, but for the most part, most of what they're earning is either earned or unearned income. Let's see. Sorry. And then, oh, you know what? This is another thing I wanted to bring up on this one. Someone asked earlier about the difficulty of care payments. So in 2014, the IRS came out, and this is more for the parents than it is for the beneficiaries. The IRS came out with regulation, it's 2014-7, which basically says if you are the caregiver of a disabled person who lives in your home and you are paid by one of the Medicaid waiver programs, that income you can choose to have as not taxable to you. And so we've recently dealt with that. We've helped a client. She didn't know that that was an option. We've helped her kind of amend her tax returns to remove that from her taxable income. And so the good news about those difficulty of care payments is if you meet the criteria, even though you're receiving a W-2 from the state for the wages that they paid you, we can actually exclude that from the income on your tax return.
Wow, that's fantastic.
Yeah, it can really help. They still, since you're getting a W-2, they're still withholding Social Security and Medicare. And so that's still going to count towards a Social Security benefit for you in the future. But the federal level of tax becomes a moot issue because that's no longer taxable on your return.
Fantastic trick.
Yeah, I kind of like that one.
Yeah.
So income for or for SSI. So SSI is the means-based program, right? Earned income is going to be your wages, your self-employment, some royalties, workshop payments. Unearned income is going to be Social Security, state disability, unemployment, dividends, and then also for SSI purposes, so not for IRS purposes, because the IRS doesn't really care if you receive gifts, but if you receive in-kind gifts on the Social Security level, they do want to know about those because that can impact your benefits. And so if I'm letting my kiddo live at home with me and he's not paying me, I am giving him in-kind support. Um, Clothing and transportation, again, in-kind support. The one thing that they removed from this a few years ago was the food. So they no longer care if we're giving our kids food. Now they care if we give them $100 and they're supposed to buy groceries. They'd rather us just give them the $100 worth of groceries, and that doesn't count. But cash that we give to our kiddos or that someone else gives to our kiddos does count for income under SSI rules. What doesn't count for income is out-of-pocket medical expenses, and then some of the temporary benefits that they can receive, and then certain payments from government like SNAP. Okay. So for a
I'm
third
sorry,
party,
I'm so sorry, before you go
no,
into this slide,
yeah.
how far back can you amend your return with that difficulty of care exemption?
Oh, that's a great question. Right now you can go, see, we're in 26, 23 would be as far back as you can go. And that might be depending on when you filed it, because the IRS has a statute for claiming a refund. So 23. The
Okay,
IRS does currently accept electronic amended tax returns, but you can also mail one in.
thank you.
All right. So when we get into third-party special needs trust, so the trust has been established. It has its own tax ID number. It is its own individual entity, and there's no money in it. So it's not drawing, it doesn't make any income. It doesn't have a filing requirement. Suddenly we put $50,000 in it and it starts to make $1,000 a year in interest. Well, because that's over $600, now we have a filing requirement for that trust. And so as long as that is sitting there with no money and no income, or it's 600 or under, we do not have a filing requirement. And then there are several types of trusts. What we typically find that our clients are eligible for is the qualified disability trust. And the reason why we like that, you'll see in a few slides, a visual, that every trust has an exemption, kind of like we have standard um, deductions on our tax return. For a married couple, that's 30,000. A trust has that same kind of number. So for a qualified disability trust, the current exemption is 5,100. Whereas for a normal trust, it can be 600 or 300, depending on if it's a complex trust or a simple trust. And so the trust can actually have $5,100 worth of income before it's subject to taxation. Okay, so for that qualified special needs trust, where we get the extra bump up in exemption, there are rules that we have to have. So they have to be age 65 and have a disability, right, defined by Social Security. They seem to define a lot of our disability definitions of Social Security. The
Mhm.
trust has to, right, we depend on them. The trust has to be funded with assets of the beneficiary, so personal savings, settlements, inheritances. managed by a trustee who has discretion over how to use those funds. And you're going to find that language is pretty standard in any of your trust documents. Cannot distribute funds directly to the beneficiary in a way that would make them ineligible. And so we're all fighting to do that anyway. When the beneficiary passes away, oops, sorry.
I'm sorry. Let me stop my share and reshare. My computer just decided it didn't know what it wanted to do with itself for a moment.
Linda
This
wants to
just,
know, yeah. And while you do that, Linda wants to know, they had a third-party special needs trust set up in 2018. Should we redo it? Honestly, you guys, the way that the laws change so frequently, I'm not saying that it needs to be redone, but it probably does need to be reviewed. And
yeah,
I would
we do.
say that, yeah, I would say that with any trust. I had a party pass away that didn't have a special needs child, but their trust was written so long ago that it didn't include some of the new things in their life. And so we ran into some things. So I think with just like with your wills, with your medical power of attorneys, all of those things need to be reviewed probably at least annually, if not, annually, maybe biannually, just to make
Yeah.
sure that it's still there. Um, let's see. So no limits on the type of expenses that we can pay for. So education, recreation, and a few slides will have a pretty long list of those things. And the trust assets do not count towards the beneficiary's resource limit for government programs. And so that's basically what the trust is meant to do. It's meant to shield our children from losing their SSI and Medicaid benefits by keeping things in the trust so that they can have assets more than $2,000 a month.
So for this qualified special needs trust,
Mhm.
this is going to have to be a first party. Is that accurate? Because it's the beneficiary, the person's own money.
No, it's usually a third party. And so, you know what? It might be able to, because it can be either one.
Okay.
I have
Okay.
both. I have both first and third that are qualified.
Okay. Okay. Yeah, I was just confused because if it has to be funded with the beneficiary's own money, that in my head says first party, but can the
Yeah.
beneficiary put their own money in there? Or is it
In
just
their
this?
in their first party, yes. In the third party, no. But and I
Oh,
probably need to rewrite that because when I was reading it through a minute ago, I was like, oh, that's middle. That's a little misleading.
okay. Okay. No problem. Thank you for that.
So to kind of show you guys, this is what the front page of a 1041 looks like. It is very similar to a normal tax return, the same kind of interest income and all those categories of income, but you'll see this one specifically, and it's a little hard to see, sorry about that, but in the upper left-hand corner, we did mark that this one is a qualified disability trust, and that's what gave us the $5,100 exemption on the bottom. So just an example of the trust return that needs to be filed. These forms are available if if you're feeling like this is something that you can handle, and sometimes it is. These forms are available at the IRS, and I'm not sure if I don't know if TurboTax supports this type of form. But sometimes if you're feeling a little antsy and you've got extra time, and if you do have extra time, please let me know how to do that. Um, then you can file these returns yourself. Again, they would be due April the 15th, though. Let's see. So here's just a visual because we were talking earlier and there's another question about the 401k. So this is why we were talking earlier about, do we want that tax deferred income to come into the trust, right? And
Yeah.
generally speaking, no, because if you look at the individual tax rates, these tax rates go up and we don't hit the 35% bracket till we're in 250,000. But I hit a 37% bracket when the trust has $16,000 worth of income. So when we can avoid it, we would choose not to put taxable income into the trust. And the most that we see that is the inherited monies from IRAs and 401ks. Those cause the biggest amount of tax, if you will. In a normal situation where I'm not up against any kind of SSI. And, we had one just the other day. Her dad, she's not disabled. So but her dad left his whole retirement to the trust, $200,000. If we had left that $200,000 in the trust and let the be taxed at the trust levels, we would have eaten it. But we passed it out to her, and we could do that because again, she's not disabled, so we don't have these walls that we're up against. But we immediately passed it to her to get a preferred level of tax on that $200,000. So
Okay.
during our lifetime as parents, especially if we are head of household or if we're married, we work with clients every day in a normal setting to get money out of a tax deferred environment to a Roth environment, even without having a special needs kiddo. Um, Especially whenever we retire and we've lost that W-2 income, but we're not quite on Social Security yet. We've got some downtime in between retirement and when we go on Social Security. We work with our clients to maximize the tax brackets, usually 22 and 24%, and we start having them do Roth conversions. Now, it's counterintuitive to the way that we have been raised because everybody is afraid of taxes. Don't let taxes scare you. And there's a few reasons why. First of all, if you leave that IRA to this trust, you're definitely going to have to pay a lot of tax on that. But if I can help, or your CPA or your financial people can help you manage your tax brackets during your lifetime, then we can pay less tax and have that money start to grow in a tax-free environment. And that way our children don't have to bear the tax burden of our choices. The other thing to keep in mind, and this is why we don't invite the CPAs to the party, if you are married and you have a spouse, then your standard deduction is about $33,000 right now, and you have a preferred tax bracket. As soon as we lose one spouse, we suddenly drop into a single position at a much lower tax deduction, and the brackets are squeezed a little bit. So that's why we tell our clients, even without children that have special needs, work with someone during those downtimes to move money from a tax deferred environment to a tax-free environment. And if you've got kiddos coming up and they're just starting their careers, have them look into the Roth situations. If they've got a 401k that's a Roth, an IRA that's a Roth, set them up for success too. But if we can keep from it, we don't want taxable income of that amount going into this trust account. And I think the next slide gives the visual as to why. So this is a single person. On the left-hand side, we have the trust. So if the trust were to receive $50,000 worth of interest income, and I chose that, it doesn't matter if it's interest, 401k. The only thing that'd be tax different is capital gains. But at $50,000 worth of income, the trust is going to pay $15,000 worth of tax. Whereas a single individual over on the right-hand side, same amount of income, 50,000, they're only going to pay $38.75. So this is just a visual example of the difference between the two brackets and why we try to keep the income out of the trust when we can. Let's see. Third party, I'm just looking at the questions.
Right, yeah, see if you want to get any of those now or save them till the end.
Third party normally doesn't have a payback. That's correct. We did the 401k. Let's see. Why not just pass the RMD to the special needs trust? A trust is not an EDB. A trust is not an eligible designated beneficiary. Let's see. And then the master pooled trust, I'm going to leave the master pooled trust to probably answer that in an email because those are their own little special nuances sometimes.
Yeah. Okay.
So deductions at the trust level. So I know you guys will hear a lot of things on TikTok about what's deductible and you can write off your whole life. That's not true. I'm definitely a dream killer when it comes to that kind of stuff. But the trust does have the opportunity to deduct some things, such as fiduciary fees. Those are not the fees to manage your accounts. Those are like if I pay Consolidated to do a special plan for me, I can deduct that fee. The trust can deduct that fee because they are going, and that's something I wouldn't have done if not for the trust. Attorney fees, you can deduct those because the attorney is is drafting documents and providing support. Accounting fees, again, documentation, I'm doing your tax return, and then trustee fees. If the trust does pay a trustee to help manage the trust and the assets in the trust can deduct those fees. And so those would take away from taxable income. Let's see. The things that you can't deduct, so the things the trust can't deduct are going to be just things that would normally be personal expenses, rent, that gets deducted, if you will, in a different way, but it's not a straight deduction for the trust. I think that's one of the most common questions that I get. Can the trust write off rent? And the answer is no, it can't. It gets around it in a different way. So now that we have all of this money in the trust, we need to be able to get it out of the trust to support our loved ones, because that's the whole point of having this set up. And so the way that we do that is by carrying out the income to the beneficiary. We've got to be sensitive to the benefits that they're getting. So SSI, we don't want to lose that because that ties directly into Medicaid. So we want to make sure we're not, making the wrong decisions. But, and so as an S&T beneficiary cannot control the assets in the trust, and that's going to be embedded in your trust documents, because it's going to say who's the trustee, what are their rights, what do they have to do, what can they do, and your attorney will work with you and they will draft things correctly so that they meet the requirements that are necessary. But in a nutshell, they give us a lot of leeway to be able to make sure that we're taking care of our loved ones. And so the distributions that we can make is this long, and I think there's like 3 pages, and they're pretty extensive, right? This should cover our loved ones' needs. This should keep them. We've even got pets and pet supplies on here, so if they've got emotional support animals or whatever they might need. If these things are done from the trust, so you want the trust to pay the doctor, you want the trust to pay the maid, you want the trust to make these, you don't want to give this to the child, right? No cash. We don't want cash to go to the kiddo, because that's going to be income to them for SSI purposes, and it's going to potentially mess with our benefits there. So in addition,
It's easier to say what the trust should not pay for. And that would be cash or rent, right? Usually
right.
that's the big two things that have to do with housing, and then cash.
Yeah. Yeah. If we can avoid the cash and the housing, then we're pretty much home free at that point. So then, in addition to the trust, we can bring in and have the ABLE account set up, which is separate from the trust. The trust doesn't own the ABLE account. The ABLE account is separate, but we can use them to work together to get other benefits paid for. And so there are eligibility requirements for an ABLE account. And this isn't your typical ABLE account. This is specifically an ABLE account for disabled. This is akin to the 529 that we set up for our college kids, because we want them to go to college and it grows tax-free. But the ABLE account is set up specifically for our disabled children. The beneficiary has to be disabled starting before age 26. And then it was 46 this year, right, Michelle? They changed it this year so that it can happen
Yes.
later in life, which I love.
Yes.
There are contribution limits. And so the contribution limit to the ABLE account is $20,000 annually. So we have to kind of keep that in mind. The kids can put their own money into this account. Other people can put money into this account too, right, Michelle? It can be all sources.
Yes, yes.
Different
It's
than
very similar, the person should have one ABLE account, just like they should have one special needs trust, maybe one first party and one third party, but generally one of each kind. But anyone can put money into these vehicles for them. And that's, the only limit would be themselves putting their own money into the third party trust. They can't do that, but
just looking at a couple of questions. John, you may absolutely be right. I will look through that. I know the trusts that we work with are not EDBs, but you could potentially be correct. I'll look into that for sure. Thank you. Yes, the trust can pay a credit card that the beneficiary. Hmm, You know what? I have to look at that. Should be able to, but let me look at that one. And then the S&T growth, income that the trust generates, what is taxed? The RMD payout is stretched. Sorry, it's moving.
I don't know what is
So
going on my computer.
inside, so on the RMD, inside of your IRA, the RMD, your IRA can do whatever it wants. It can make $1 million, but none of that is taxed until it comes out. So the RMD itself is what's going to be taxed, not the dividends and capital gains inside of the IRA. I think that was the question. If not, let me know.
Yeah.
Okay.
And
So
Anna is asking what's the difference between the trust and the able. So these two kind of work really well together. I always think of the able as more short-term savings. There's limits on how much you can put in, but there's really not any limit to what you can use the money for. Whereas with the special needs trust, we think of that as like long-term savings. And there's no limit to how much you can put in. But there are these rules about, you can't use it for housing or cash if you're still getting SSI because it would reduce the amount of SSI that you get.
right. But there are some situations where we're able to have the trust pay into the able account and then have the able account pay those living expenses, and it doesn't count against us. But we do have to be careful if the able account starts to encroach on $100,000 worth of assets, that can start to impact us for SSI, but not Medicaid.
Yeah, and the
Excuse me.
last thing that you need to know about the able account, and someone, Karen, thank
Yeah,
you for putting that in the chat, is that
to pull
just
back.
like the first party special needs trust, the able account also has that Medicaid reimbursement clause to it. All right.
Perfect. So when we look at the tax exposure for a third party trust, we want to be mindful of, and some of these things we can't control because you guys, we're paying financial advisors to put us into positions that generate us income. So it's a little strange. We start working together because Michelle's job and that team's job is to create as much income for you as they can off the assets that you own. And then our job is to come in and try to mitigate that for tax purposes. And so that's where the planning comes in. Let's look and see what this trust is going to generate: interest, dividends, capital gains, RMDs from traditional IRAs. Again, if you've got a Roth, leave the money in the Roth as long as you can and pull that out at the last minute. It won't be taxable to the trust, but you want tax-free growth as long as you possibly can. See how much we need to live and how we can control that. And then how much can we pay out of the trust on behalf of the beneficiary, keeping in mind that that probably creates a DNI, so a distributable net income deduction to the trust, which becomes then income to our beneficiary. And keeping in mind that when we exceed about $25,000 worth of income, suddenly their Social Security becomes taxable as well. So we've kind of got to keep all of that in mind when it comes to the tax side of it. But when we can, we want to pass out the income from the trust just because of the different levels of brackets that we have between those two environments. The trust is not tax favorable. That trust is meant to protect assets. It was never intended to be a tax shelter. Let's see. Okay, and then the next, Michelle, anything to add to that?
No, but there are a couple of questions. Denise is saying if you put all your assets in the special needs trust, how do you pay for housing? Well, the rule with the housing being paid for by the special needs trust affects SSI. In theory, by the time your child is using the special needs trust, because remember, I just said we think the special needs trust should be long-term savings. The ABLE account is short-term savings. You should have both. They work together. But that long-term savings Your child will come off SSI benefits and move on to a different benefit based on your work history later on in life when you turn on your Social Security retirement benefits. At that point, when they're no longer receiving SSI, you don't need to follow that rule because that rule impacts SSI. So if you're not getting it anymore, then you can use the special needs trust to pay for housing at that point. And that's why it's so important to have this team of support to walk you through these nuances so that you understand how it all works.
And that's why it's difficult to answer every question exactly correctly because, for example,
Mhm.
Max's dad, Max is already on SSDI at 13 because his dad is older and that's our
Yeah.
decision. So Max will never probably be on SSI because he'll go from SSDI and he'll stay on that path and
Hmm.
forever. So he'll never have, I'll never have to quote unquote worry about the SSI reality for him because he'll always be on SSDI. And that was something that Michelle's team helped me realize when they looked through everything that they did for me and came back with some really interesting stuff. So while we try to answer everything here today, it may not exactly fit your situation. And so we may have to look at the
Yes.
actual facts and circumstances.
And that's why we offer free initial consultations. That's why we do all these webinars. Your questions in the chat box I see about ABLE accounts, we have an entire webinar just about the ABLE accounts. So, we are here to help. If we don't get you to your question today, schedule your free consultation or reach out to us or to Shelli. We'll help you.
If your kiddo starts working, can she deposit money into the ABLE account or the third party trust? She can deposit money into the ABLE account, and if she has a first party trust, she would deposit her paycheck there. The third party would not be for her because that's her money. Let's see. Okay. So disability deductions at the individual level. So the other thing that happens to us as parents, right? Unlike normal children, our children may be with us for a long time in tax terms as well. So the standard deduction right now for just a single individual person without doing anything is $15,750. Deductions, those include a 7.5% floor, meaning that the first 7.5% of your income is excluded. You'll never get it. Deductions are your typical, like you and I would take on our normal 1040, medical, home or car, the increase in value for a home modification, conferences, special school expenses. But I'll be honest with you guys, out of the 450 tax returns that I do, the only people that are getting to take medical deductions are my seniors that are living in a medically necessary environment. Other than that, we're just not getting medical deductions on Schedule A because our standard deduction is so extremely high since 2018 when they simplified the tax code. And yes, it got simpler, but we don't always feel it that way. Um, but for us as parents, we will still have the opportunity to, if the child is our dependent on our tax return, we would have the option for the $600 camp credit. So if you're sending them to, a day camp during the summer, there's the potential for that credit. And then our dependent credit. So we don't get a child tax credit because they're no longer a child. It turns into a dependent credit, which is capped at 500. And the 500 can go away depending on our other sources of income. Um, let's see. And then for claiming our dependents, which is the next slide, I think.
No.
Yeah. So claiming your dependents. So typically, if you have a normal child, you get them until they're 18. Once they are 19, they come off. But if they go to college, then they can stay with us till they're 24. And it doesn't matter how much they make as long as you provide more than one half of their support. So if little Tom has a job and he's making $12,000 a year, but you're still paying all of the expenses for him to go to school and that's his slush fund money, as long as you're providing more than half the support and he's only away for a temporary absence at school, he's still your child. For our disabled, or your dependent on your tax return. For our disabled kiddo, they can live outside of the home. So we have our children that sometimes live in a group environment and stuff like that. Their gross income cannot exceed for 2025 $5,200. We still have to provide more than half of their support, and they need to be permanently or totally disabled. So if that meets the criteria, then we can still claim them. Now, the IRS does have a worksheet for determining our support, because our support is going to be made up of how much, how much do we pay for our house, and how many people live in the house, and how much are they contributing towards their meals, and how much are they contributing towards their entertainment. And so if you're questioned about it, you can use the worksheet. The IRS also has really neat little tools on their website, where you can go in, it'll run you through a list of questions that you can answer to kind of help determine if that person, and this can be for your normal children, your disabled children, your mom, your dad, to help you determine who might be a dependent for your tax return. And so I
Wow.
think if you Google like IRS, I'll have to remember what it is, but if you Google like IRS questions, it's there. I've seen it several times. And sometimes I have to walk through it myself when I'm working with the client. Um, so gifts to a third party special needs trust, 2026, that gift limit is 19,000. And you are so typically, if you are giving gifts of 19,000 or less, you don't have to report that to the IRS. But gifts to a third party special needs trust, even when they're below the amount, have to be reported on a gift trust tax return. So you might choose to, instead of gifting to the special needs trust, you might choose to gift to the ABLE account, because that doesn't require a tax return. It just makes it a little bit simpler in terms of paperwork. And then, okay, so I know that was a lot. Absolutely a lot. And I know we have some questions that we did not get to, but I will happily email you guys back answers so that we can look at those. But let's see. Do we have, yeah, that SSDI and SSI, you guys, it's crazy. Kids start working. I think we got to a lot of your questions, but once we're wrapped up with the webinar, I will look back and see if there's anything that I didn't answer. If you think of something as soon as the webinar ends, because that's what happens to me, like I'm like, oh my gosh, email the team, they'll send it to me and I will respond. If I need more facts and circumstances to kind of help you guys out, I will ask for those. Um, I do have a practice, but you guys, I love this part of my practice. And so I will provide as much support as I can, and try to answer any of those questions for you guys.
Yeah, and I mean, if anyone has a last question to throw into the chat box that we can try to help you out with, I just wanted to share these last few slides about Consolidated Planning Group and some of the things that should be on your radar as you're thinking about planning for the future. Think about your letter of intent, your legal needs, and those financial needs, and how are we going to have enough money to leave for your child? Like I said earlier, you will receive these slides in your email later. And when you do, this will take you to our upcoming webinars so that you can pre-register. But this slide I'm going to keep up for the duration of the meeting, just so that if you want to schedule your free consultation with Consolidated Planning Group, you can use the QR code, you can call or email the office, or you can call and email me directly. I've put my information in the chat box. I also put Shelli's email in the chat box earlier, but she can do that again.
Yeah.
And then this slide will have our links to our YouTube, Instagram, podcast, and Facebook. So the last question I see, we bought our disabled child a house and we pay for it. It's in our name. Is that okay? Is there a problem with that? And Carol, I know that we're going to be answering a lot of your questions, but Shelli, what would be some tax consequences to leaving a
So,
house for your loved one?
so tax wise, while they're alive, that would be considered a second home for IRS purposes, right? We're just letting our child live there as a second home. But we are giving them something of value. And so that's potentially going to impact our SSI, because we're giving them fair market rent for free, basically. So maybe we talk about having them pay something to kind of avoid that. But yeah, so tax wise, no. And then I guess the follow-up question to that Carol, is what's going to happen to that house when you pass away? Where are you going to live that or leave that house? Is it going to go to him or her directly? Is it going to go into a trust? I think those are some things that we need to maybe consider to make sure that we don't knock them out of eligibility.
Yeah, and we always talk about, don't forget that that house might be paid for, but you still need to pay taxes and maintenance and upkeep and insurance and making sure that those things are in place for your loved one who takes on that house is going to be important. I'm grabbing your email to put in the chat if you want to respond to that last question, and then we will have to shut it down.
Okay. Let's see. Annually, he receives SS, which is less than 20,000. Can I claim him as a dependent? Rana, do you pay for more than one half of his support? That comes down to kind of that question. Do you pay for more than one half of his support? On that one, I would use the link to the IRS support web worksheet and see if you do. Because if you
Okay.
do, then yes.
All right, perfect. Well, again, thank you so much, Shelli, for being here with us today. This has been great information. I love that we're able to share with the community. Thank you to all the participants who joined in with us. I'm sorry that I'm having some weird computer problems. Hopefully, by our next webinar, that will be taken care of. But again, if you need us, we are here to help. You can reach out to Shelli, or you can reach out to me at Consolidated Planning Group. We will, at Consolidated Planning Group, we will be reaching out to you to see if you want to schedule this initial appointment with us. Our goal is to answer your questions to see if we would be a good fit to work together. It's low pressure, though, I promise. Thank you all so much. I hope you have a great day.
Thanks, you guys.
Bye, everybody.